Types of options calls, unlocking the world of option strategies. Traders often jump into trading options with little understanding of the option strategies that are available to them. There are many option strategies that both limit risk and maximize return. With a little effort, traders can learn how to take advantage of the flexibility and power that stock options can provide. In this video, we will discuss about option strategies that every investor should know. So before we get started, make sure to hit that like button. Also subscribe to my channel. 1. Long call. A long call is an option strategy where an investor purchases a call option with the anticipation that the price of the underlying asset will rise. By owning the call option, the investor has the right, but not the obligation, to buy the underlying asset at a predetermined price, known as the strike price, within a specific time frame. Let's consider an example to illustrate the long call strategy. Suppose an investor is bullish on a particular stock. Let's call it XYZ, which is currently trading at $50 per share. The investor believes that the stock's price will increase in the near future. They decide to purchase a call option with a strike price of $55 that expires in 1 month. The premium, or the cost of the option, is $2 per share. If the investor's prediction is correct and the price of XYZ stock rises above $55 within the 1-month period, they can exercise their option. For instance, if the stock price reaches $60, the investor can buy the stock at the predetermined strike price of $55 and then sell it at the market price of $60, resulting in a profit of $5 per share, excluding transaction costs and the premium paid for the option. However, if the price of XYZ stock fails to rise above the strike price of $55 before the option's expiration, the investor is not obligated to exercise the option. In this scenario, the investor would lose the premium paid for the option, which is the maximum potential loss. 2. Covered call. A covered call is an option strategy where an investor sells a call option on an underlying asset they already own. This strategy is often used when the investor has a neutral or slightly bearish outlook on the asset's price movement. By selling the call option, the investor receives a premium, which provides some downside protection and generates income. Let's consider an example to illustrate the covered call strategy. Suppose an investor owns 100 shares of stock ABC, which is currently trading at $50 per share. The investor believes that the stock's price will remain relatively stable or decline slightly in the near term. They decide to sell a call option with a strike price of $55 that expires in 1 month. The premium received for selling the option is $2 per share. If the price of stock ABC remains below the strike price of $55 until the option's expiration, the call option will expire worthless. In this case, the investor keeps the premium received from selling the option as profit. They can then decide to sell another call option if desired. 3. Bull call. A bull call spread is an option strategy that involves buying a call option with a lower strike price and simultaneously selling a call option with a higher strike price on the same underlying asset and expiration date. This strategy is typically used when an investor expects a moderate increase in the price of the underlying asset. The bull call spread allows the investor to potentially profit from the upward price movement while limiting their potential losses and the cost of the trade. Let's consider an example to illustrate the bull call spread strategy. Suppose an investor is bullish on a particular stock. Let's call it XYZ, which is currently trading at $50 per share. The investor believes that the stock's price will rise moderately in the near future. They decide to execute a bull call spread strategy as follows. Buy a call option. The investor purchases a call option with a lower strike price. Let's say they buy a call option with a strike price of $55, expiring in 1 month. The premium for this option is $2 per share. Sell a call option. At the same time, the investor sells a call option with a higher strike price. They sell a call option with a strike price of $60, expiring in 1 month. The premium received for selling this option is $1 per share. By buying the lower strike call option and selling the higher strike call option, the investor establishes a spread. The difference in strike prices, in this case $5, represents the maximum potential profit for the strategy. 4. Synthetic call. A synthetic call is an options trading strategy that aims to replicate the risk-reward profile of a long call position by combining other financial instruments. It is called synthetic because it creates a position that behaves similarly to owning a call option without actually buying the option itself. The synthetic call strategy is useful when an investor wants to gain exposure to the price movement of an underlying asset, but prefers an alternative approach to outright purchasing a call option. Let's consider an example to better understand the synthetic call strategy. Suppose an investor is interested in gaining exposure to a particular stock. Let's call it ABC, which is currently trading at $50 per share. However, instead of buying a call option on stock ABC, the investor decides to create a synthetic call using the following components. Long position in the underlying asset. The investor buys 100 shares of stock ABC at the current market price of $50 per share, investing a total of $5,000. Long position in a put option. The investor simultaneously purchases a put option on stock ABC with a strike price of $50 and an expiration date that aligns with their investment horizon. The premium for the put option is $200. By combining these two components, the investor has effectively created a synthetic call position. Here's how the synthetic call behaves in different scenarios. If the price of stock ABC rises above $50, the investor benefits from the appreciation in the value of the underlying shares they own. They can sell the shares at the higher market price, realizing a profit. 5. Married call. The married call strategy is an options trading strategy that involves buying a stock and selling a call option on the same underlying asset. This strategy is typically used when an investor owns the underlying stock and wants to generate additional income by selling a call option against it. The objective of the married call strategy is to profit from the premium received from selling the call option while still participating in potential stock price appreciation up to the call option's strike price. Let's consider an example to illustrate the married call strategy. Suppose an investor owns 200 shares of stock XYZ, which is currently trading at $60 per share. The investor believes that the stock's price will remain relatively stable or slightly increase in the near term. They decide to implement a married call strategy as follows. Buy the stock. The investor already owns 200 shares of stock XYZ, which they purchased at the current market price of $60 per share. The total investment in the stock is $12,000. Sell a call option. Simultaneously, the investor sells a call option on the stock. Let's say they sell a call option with a strike price of $65 and an expiration date that aligns with their investment horizon. The premium received for selling the call option is $2 per share. By selling the call option, the investor collects a premium of $2 per share, generating income of $400. 200 shares x $2. This premium acts as additional income for the investor and provides some downside protection. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.